They tell you the price of money is just a number, a percentage, a technical setting decided in a meeting room somewhere far away. But that number quietly decides who gets rich slowly, who breaks suddenly, and which parts of the economy are allowed to breathe. Most people never choose it. Most politicians don't fully control it, yet everyone lives with the consequences. So the uncomfortable question is not what interest rates are, it's who really controls them, and why the answer is more complicated than we're told. Pause for a moment and think about your own life, your mortgage, your rent, your credit card balance, your job security, even the price of food. All of these respond, directly or indirectly, to the price of money. And right now, that price is doing more political work than most elections. This matters now because interest rates aren't just moving, they're being used as tools, as signals, as pressure points. And the story we're given, that rates rise to fight inflation and fall to support growth, is only the surface layer. Underneath it is a quieter system of incentives, constraints, and power. To understand who controls the price of money, we have to start with how the system actually works, not how it's explained in textbooks. In theory, central banks set a policy rate. In the US, it's the Federal Reserve. In the UK, the Bank of England. Elsewhere, similar institutions with different names and the same mandate. They adjust short-term interest rates to influence borrowing, spending, and inflation. That's the clean version. The real version is messier. Central banks don't control money directly. They influence it through banks, markets, and expectations. When a central bank raises rates, it's not flipping a switch. It's sending a message. Borrowing should become more expensive. Risk should feel less comfortable. Speculation should slow down. Growth should cool. But whether that message actually lands depends on who's listening and who can afford to ignore it. Large institutions don't experience interest rates the same way households do. Neither do governments. When rates rise, a family feels it immediately. Mortgage payments adjust. Credit card balances grow heavier. Discretionary spending tightens. But a major corporation with access to capital markets can refinance, hedge, delay, or pass costs forward. And governments, especially large ones, sit in a category of their own. This is where the story becomes uncomfortable, because the price of money is supposed to discipline everyone equally, but it doesn't. Governments borrow at massive scale, and their debt is deeply woven into the financial system itself. Pension funds hold it, banks rely on it, markets treat it as collateral. So when interest rates rise sharply, governments don't just feel pressure, they become part of the pressure. Higher rates increase debt servicing costs. That forces trade-offs, cuts, taxes, inflation tolerance. This is why central banks are said to be independent but never isolated. They operate in a narrow corridor. Raise rates too little and inflation erodes trust. Raise them too much and you destabilize governments, banks, or both. So who really controls the price of money? Not just central banks, not politicians alone, not markets by themselves. It's a triangle. Central banks set intent. Markets test credibility. Governments define the limits. And markets are not passive observers in this process. They react instantly. Bond markets, in particular, act like referees with no uniforms. If investors believe inflation will persist, long-term rates rise, regardless of what central banks say. If they fear recession, rates fall before policy changes arrive. This creates a strange dynamic where central banks appear powerful but spend much of their time responding to signals they didn't fully choose. Sometimes they lead, often they follow. There's a quiet irony here. The institutions meant to stabilize the system depend on market confidence, and market confidence depends on belief, not certainty. Which brings us to expectations. Interest rates don't just work through math, they work through psychology. If businesses believe rates will stay high, they delay hiring. If consumers expect prices to rise, they spend faster. If investors assume central banks will intervene, risk-taking increases. This is why a single sentence from a central bank chair can move trillions of dollars. Words matter more than actions, signals more than settings. And this is where the system quietly shifts power, because expectations are shaped by those who speak loudest, earliest, and most credibly. Large financial institutions don't wait for official announcements, they position ahead of them. By the time the public feels rate changes, markets have already priced them in or dismissed them. This creates a timing gap. Those closest to capital adjust early. Those dependent on wages adjust late. The price of money moves first for those who already have it. Now consider the math that rarely makes headlines. Small changes in interest rates have outsized effects on highly leveraged systems. When debt levels are low, rates can rise without much damage. When debt levels are high, public and private, rates become dangerous. Global debt today is not small, it's historically elevated. This means central banks are operating with less room than they admit. Every rate hike tightens not just spending, but financial plumbing. Liquidity dries up, fragile institutions crack quietly, and when something breaks, the response is rarely symmetrical. Support flows upward first. Stability is prioritized over fairness. This is why crises often look surprising, but aren't. The public narrative focuses on inflation numbers, employment reports, and quarterly decisions. The underlying reality is a system balancing credibility against fragility. Interest rates aren't just prices, they're pressure valves, and pressure doesn't disappear.
It shifts. If rates stay high, growth weakens, unemployment rises, and political pressure builds. If rates fall too fast, inflation returns, asset bubbles inflate, and inequality widens. There is no neutral setting, which leads to the final discomfort. The price of money isn't controlled by a single authority. It emerges from a negotiation between institutions that cannot fully admit their constraints. Central banks speak in certainty while managing uncertainty. Markets trade confidence while fearing collapse. Governments promise stability while carrying debt that assumes low rates forever. And the public is told this is all technical, boring, necessary. But the truth is simpler and more unsettling. The price of money reflects who the system is designed to protect first and who adjusts last. It tells you where risk is allowed to accumulate and where pain is eventually absorbed. So the next time interest rates move, the real question isn't whether they're going up or down, it's this: when the price of money changes, whose reality changes first and whose is allowed to wait?